Well, and as he said about the kids, everybody has to talk about the kids when they stand up in front of people. And 2, 7, and 11, and the 2-year-old's 2 today. And we were going to have a little party this morning to give him his presents and stuff before I went to the office, but this was a little earlier, so my wife wasn't going to wake him up. But the 2-year-old, it's okay, because he doesn't really know that today's his birthday, and so he can wait. But it is a Bob the Builder birthday. Tons of Bob the Builder stuff. He just loves Bob the Builder. And the neat thing about watching or reading Bob the Builder, when I read it to him, is Bob is nice to everybody. Bob is always trying to do the best job he can do. It seems that everything Bob does always turns out right. Even if there's a little mess up down the road somewhere, it still always turns out right in the end. And in the end, everybody goes home, has tea and has cookies and says goodnight and goes to sleep and everything's cool. All works. Well, as most of us know, that's not real. Unfortunately. And when you look at the title of the visit today, and by the way, I don't give speeches, I don't talk, I just visit. And visit with a lot of people at once, but visit. It might look like the title is one of those, you know, how to get rich, how to make money, all that, which it's not. The way I'd look at it is well, let me say it in this way. The story of a fellow about how he made his fortune. This fellow went to the market, like a Saturday farmer's market kind of a thing, and he bought an apple for 5 cents. He took it home, and he spent the evening polishing it up until, boy, it was bright, it was nice, it was the best looking apple you'd ever seen in your life. He took it back to the market the next day, remember he paid a nickel for it, and he sold it for 10 cents. He thought, hey. So he bought 2 apples, took them home, same thing. He did this until he had amassed $1.60. It was then that his in-laws passed away and left him several $1 million. That's how he made his fortune. The way that most of us look at income is well, number one, we have to have income. Rob and I were talking a minute ago that, yeah, that darn thing, you got to have that income. And most of us get that income from some type of line of work or job, whatever that might be. But then again, there's that big R word down the line, the retirement word, where you're not working anymore and you've still got to have that income. How do you get that income? It depends on, I guess, what kind of income you want. If you want unpredictable income, if you want flat and non-rising income, or if you want rising income. Right now, I would wager to guess that most of us in the room have something like a 401k, 403b, whatever, some type of retirement plan through your company or that you've done on yourself. Typically, if it's a 401k or something of that nature, you're limited, pretty limited as to what you can put the money in. Usually mutual funds, sometimes annuities, sometimes company stock, but that's pretty much about it. Not good, bad, or indifferent, just, well, I guess it is indifferent, that's the way it is. How do we choose those in the right manner? How do we look at them? How do we go about the choosing of the different types of investments, whether it's in that 401k or whether you're already retired and figure out what to do with it, or you're going to retire next year? How do you pick it? You could buy all the money magazines, all the smart money magazines, and all that kind of stuff, and read everything you read, and what you're going to get is about 575,000 different opinions. And which one works for me? If you've got a better idea as to what you can expect from a type of investment, I don't mean a specific one, but a general type of investment, you'll do a better job of figuring it out, I think. Bonds, for instance. Bonds give you a predictable, flat, non-increasing income, whether we're investing in a bond fund or an individual bond. Now, I have a personal bias. My personal bias is against bond funds because, well, typically, if I go back first and we say, why does a bond go up or down in value? Interest rates. Is that Debbie? Yeah, you're on. She has the answer, and let me show you. I like to get as simple as I can because that helps me understand it. That is a teeter-totter, right? Crude, but it's a teeter-totter. If we say all bonds cost $1,000 when they're new, which they do, I don't know why, some cat a long time ago thought that was a good idea, and let's say they pay a stated rate of interest. Let's pretend this bond is 5%. If rates go up, bonds go down in value. If rates go down, bonds go up in value. That's it. Nothing else matters. Let's assume the bond is insured and steady, and that's all that happens. So What's a bond going to do? It's going to pay you a flat rate of interest for as long as you own it. You should not expect the bond to go up in value significantly. You can buy those bonds tax-free. You can buy them taxable. If you buy an Oregon State municipal bond, it is tax-free, typically federally and state tax-free. Depending on your tax bracket, it maybe could be a good deal. For income now, it's not very good for income later when you look at inflation, because they don't go up in value. There is one bond, though, before I get off of bonds real quick, that can go up in value, and that is a zero coupon bond. What's a zero coupon bond? Everybody knows what a savings bond at the bank is. You pay 50 bucks for it, and at some point in the future it's worth 100, right? You got no interest along the way. At the end, you got your $100, which was your $50 investment, plus the interest. Zero coupon, no monthly or quarterly or semi-annual payment. You can buy U.S. government bonds in that manner too, in a zero. They can go up or down significantly. So if interest rate markets are right, you could invest in a zero coupon bond and see that increase significantly in value if the markets do what they're supposed to in your mind. There is one big catch to that I want to throw out. I would never suggest to someone that you purchase a zero coupon bond in a taxable account. And you laugh because you know why. When those bonds don't pay interest, which we just said they don't until the very end, you get taxed as though they did. Doesn't go over real well. I got a tax bill for something I didn't get. The good news is at the end there's no tax at the end, but it's best to buy those in a type of retirement account if you're looking for a way to grow money with bonds. Annuities, lots of annuities. What's the thing that most people don't like about annuities? They are typically very expensive. And you usually do not get a significant enhancement over what you had, especially if an annuity, like a variable annuity, which is a way to own mutual funds, mutual fund type investments, tax deferred. If it's in an IRA, what do you get out of that? Your IRA is already tax deferred. If I buy a tax deferred annuity in it, what did I gain? You gained a higher annual fee is what you gained. Or no, wait a minute, I'm sorry, you lost. The people that sold it to you gained the higher fee. That's how it works. Usually not the first idea to go with. There can be times when they're appropriate, but not always. That's the potential for rising income, but it's more expensive. You can buy a fixed annuity. A fixed annuity is like a bond. It's not a bond, but it's like, pays a flat rate of interest for a specific amount of time. At the end, you get your money back. It's tax deferred, so it's taxable at the end. All right? The last is an immediate annuity. An immediate annuity is, anybody here might be familiar with PERS. Person retires from a public job and they have PERS, and PERS says we'll pay you X amount of dollars for the rest of your life. That is an immediate annuity. And if it's a straight, just based on your life, when you're gone, so's the money. Usually that does not excite a whole lot of people, the part about when you're gone, so's the money. If a person had no beneficiaries or they didn't want to support anything, they wanted the highest income, it could work, but again, they're expensive for what you're getting. Another thought, of course, mutual funds. All of us that have a 401k or similar, we have access to mutual funds. And there's, gosh, I don't know what the number was, 20, 30,000 different mutual funds you could pick from, and it's scatterboard. There's all kinds of folks, magazines, places that'll tell you how to pick them, but in the end, think of it this way, just boil it down from 25,000 feet and say, a mutual fund is nothing but a basket of investments. And it could be a basket of stocks or a basket of bonds or a combination of the two. What kind of stocks does it own? Do they pay dividends? Are they growth stocks? Are they new companies? Are they old companies? What is it? And how much does it cost me? I don't like to be the guy that's always standing around saying this is too costly, this is too costly, because you do get what you pay for. But there are lots of mutual funds that charge, what would be the word, Debbie, horrendous amount of annual fees, possibly? Some of them are just absolutely crazy. And they charged that because back in the late 90s, when everything went up, those funds made tons of money, and people didn't care what they were paying because they were making a ton of money. Well, when the market went down or went sideways, they didn't look so good. So they're starting to fare those out a bit. But understand that they are costly, they can be very costly, and none of them are free. No mutual funds are free. None of them are free. They charge something somewhere, whether you see it on the surface or not. Somewhere there is a charge on a mutual fund. But in a 401k, that may be our only choice. It's not a bad choice. Just understand that a mutual fund is not anything special in itself. We have to figure out which type of mutual fund fits you. Another one about mutual funds, a positive, instant diversification. Instant diversification. You can diversify $5,000 if you put it in a mutual fund. If you were going to buy individual stocks, it would take more money to get a diversified set of stocks. Mutual fund, instant. That's why they've done so well for so many people, is you have that diversification. Of course, if you buy a mutual fund that only has 20 stocks in it, you're not very diversified. Another thing, too, that has been more popular in the last few years are what's called exchange-traded funds, ETFs. Exchange-traded funds are nothing other than, think of it this way, a mutual fund type thing that is traded on the stock market minute by minute. Mutual funds, are priced at the end of the day. An exchange-traded fund is priced during the day. They could be specific to companies in China, they could be specific to growth companies or international or pharmaceuticals or whatever. But an exchange-traded fund in itself is not anything special, fancy, whiz-bang. It's just another way to get diversification with stocks and or bonds. Most of them are stock funds. There are some that have bonds, but most of them are traded stock. There's tons of them out there. And again, what does this particular item do for me, and why should I buy it over something else? And I'm going to get to that point in just a second. One thing exchange-traded funds have, not all, most, that is kind of neat. They have the ability, or you would have the ability as an owner of an exchange-traded fund, to transfer it in kind in the future. Most of them have minimums. But let me give you an example. You're going to invest X number of dollars, and you want to own individual stocks. You just want to, but I don't want to buy one at a time, because if I buy one at a time, I'm going to buy the right one at the wrong time or the wrong one at the right time or whatever. If you bought, say, an exchange-traded fund that allowed a conversion, then at a set point in the future, be it 1 year, 2 years, 5 years, 10 years, whatever it happens to be for that particular exchange-traded fund, you have a choice. You can take your money out and go buy bubblegum with it. You can invest into another exchange-traded fund with that company or another company, or you can say, exchange-traded fund, send me the representative individual stocks that I owned in that exchange-traded fund, and they go into your account. That's a non-taxable event in most cases. And it's a neat way to build a portfolio of stocks without buying one at a time. But again, exchange-traded funds have costs. Everything has a cost. They have internal fees. The downside I've heard people say about an exchange-traded fund, typically they don't manage the fund. It's a basket of stocks, and usually that basket of stocks is static for a period of time, as opposed to a mutual fund where they can change them any minute. So sometimes if you are paying too high of a fee to have something that's static, I'm not sure if you're getting what you're paying for, because it's not managed. Anyway, next point, stocks. Growth stocks, income stocks. Everybody here either has or at one time has probably owned a growth stock or a mutual fund that has growth stocks. And let me say, when I say stocks, most of what I say about stocks could be translated into stock mutual funds. Right, fair enough. But I'm going to talk about individual stocks. Individual stocks it's nothing more complicated than ownership. You own the company. If this restaurant became a public corporation and they had 100 shares of stock they issued, and you bought 10, and you bought 10, and you bought 50, and the rest of you bought a certain amount of shares, you each own a piece of the company. Now, he's got the full weight, because he owns 50%, he can call shots as far as the management of the company, but you all own a piece of it. If this company makes money, you make money. If the company doesn't make money, you don't. All right? Now, you buy shares of, I don't care the company, Walmart, General Electric, Coca-Cola, Intel, whatever. You own a piece of that company. It may be very small, but you're an owner, and I would make this one suggestion. Whenever you look at a stock, or anybody calls you and tells you about a stock, or you have an advisor that says this, says that, ask yourself one question. Would you own that company? I don't mean the stock. Forget the stock for a minute. Would you own that company? For instance, if it happens to be across the street, let's say Fred Meyer, which is Kroger, but let's call it Fred Meyer for a minute. Would you feel comfortable if everybody knew that you owned Fred Meyer? Is it nice when you go in there? Do you get good service for what you want? Do you get good price for what you're buying and that type of thing? Are you comfortable? Would you want the Fred Meyer image on you? If the answer is yes, then buy the company, if everything else fits. If it's not, don't buy it. No matter how cool it looks or how good somebody makes it sound, if it's not something you would want to be associated with, don't buy the company. Because again, you're not buying stock, you're buying a company. With individual stocks, you can have your cake and you can eat it too. The company can grow in value over time. By the way, let me throw in one little caveat. The fast, like day trading and buying a stock and selling it 2 days later because it goes up and all that, I don't do that. I don't mess with that because the way I look at it is that and options, same kind of thing. If somebody wants to do that, they would be better to take that money and go to a place like Reno and Vegas, because pretty girls will bring them drinks and food and stuff while they're playing, and I won't do that. But you're going to lose your money at some point, either place. I'm talking about long-term investing. Your cake and eat it too means this company can go up in value, and this next important thing, which is the whole focus of the talk, is the company can pay dividends. Dividends, there's 4 things about dividends that I like. Dividends are your friend. Dividends are your friend. Dividends are your friend. And rising dividends are your best friend. That's how income is generated over the long term, is by dividends. Now growth too, absolutely, but dividends. Why does a growth stock that doesn't pay dividends, why does it suffer more in a bad year than a similar type company that does pay dividends? Well, it's easy math. If this stock goes down 5% and it doesn't pay a dividend, it's down 5%. If this stock goes down 5%, but it pays a 4% dividend, we really only lost 1%, right? So they help you in the down markets. They give you cushion, I guess. Gymnastic mat. What do you call that? A mat. Something to land on that's a little softer because you've got the dividends in there. That's why you probably saw in 2001 and 2 when the markets really did pretty bad. What did somebody say to me yesterday? They said it was the worst bear market in 73 years or 74 years. The growth stuff went to pieces. Things that pay dividends, companies that pay dividends for a long time, held up fairly well. I'm not saying some of them didn't lose money, because a lot of them still did, but they didn't lose near as much. The thing about a dividend is it's only as quality, or it's only as good as how long the company has paid a dividend. If this brand new company over here has paid a dividend for 3 years, well, that's great. But I don't know about you, I am not willing to put my retirement dollars in something that only has a 3-year track record. I have more than a 3-year track record, and I want to make sure that wherever I send my money has more of a track record than that as well. So I want to look for companies that paid a dividend for a long time. That's my first little screen, I suppose. And by a long time, here's what I mean. I have a neat little book here that I get monthly, and it's very simple and plain, and it just says it's an S&P stock guide. It's not my company, it's just Standard & Poor's issues this out. And the neat thing about it is it tells me all kinds of info that I really don't care about, and it's old news. One thing it does tell me that's really, really nice to use, it tells me on every company that's traded on the stock exchange how long they've paid dividends on the common stock without skipping a beat. By skipping a beat, I mean they can't miss 1 quarter of the year ever. They got to pay dividend each quarter. So how long has the company paid those dividends? Well, I'm going to look at, and again, this is not a recommendation at all, I'm just pointing them out. A company like the Bank of New York. Anybody want to guess how long the Bank of New York has paid dividends on their common stock without skipping a beat?
1908.
1908. That'd be a long time. Actually, the Bank of New York has paid dividends on their common stock without skipping a beat since 1785. Okay, I'm not good with math, but that's like 200 plus years, right? Wow, I'm pretty comfortable with that. Why am I so comfortable with it? What is Bank of New York going to do to make sure they don't miss next quarter's dividend? The answer is they're going to do everything that it takes, because if they skip that quarter dividend, their history goes from paying dividends since 1785 to paying dividends since 2006. Not near as cool. The Bank of America, dividends since 1903. Wow. That's just, wow, that's fantastic. That is 103 years. I can count on something like that. And one more thing to throw in, when you look at bonds or bond type investments from a company, and you try to get a level of safety with those, if you look in the book and you find out that let's say Bank of New York's paid dividends since 1785 on their common stock, what have they also done? They have also paid dividends, the interest on their preferred stocks. They've also paid it on all their junior bonds and senior bonds and lien bonds, all of their bonds, because a company, by law, can't pay the dividend on the common until after they've paid all that other stuff. Wow, that's pretty solid. I want to go with that. 100 years, that works good for me. 70 years works good too. But the point is, rising dividends are even better. So I want a company that has paid dividend for a long time, my first screen. Second screen, I want them to show that those dividends are going up. Why does a company pay dividends in the first place? Why? This is the audience participation part. Why does a company pay dividends? They have extra money and they want to share it with you because you bought their stock and they're happy you did, right? Okay. Why do they raise them? Same answer. Right, same answer. And to keep you as a shareholder. They don't want their stock traded daily. They don't want it wild swings in it. Why don't they want that? Why does the company not want their stock traded every day and I mean, you know, excessively traded up and down? Why don't they want that?
Makes them appear unstable.
Yes, makes them appear unstable, absolutely. And for purely selfish reasons, the controllers of the company, the large shareholders of the company, don't want their personal fortunes going up and down and up and down. They pay dividends, they pay rising dividends. That helps the shareholder hold on to those shares and keep them. If you looked at the history of companies that have paid dividends versus the ones that haven't, and I got a little chart here that I just printed out yesterday just to kind of give us an idea. June of 96 to June 30 of 06. So we have 10 years, which encompasses that really, really bad, worst bear market in however many years in 01, 02, however that shaked out, part of beginning of 03. Stocks that did not pay dividends, stocks in the S&P 500 that did not pay dividends, average return 2.7% over that time period. 2.7%. Again, they took a big hit in 01 and 02. Stocks that did pay dividends over that time period averaged 12.1%. Well, why? Number one, the thing we talked about, the safety net of the dividends, but also people fled to safety. Okay, my .com stock isn't doing well in 2001 or 2. I'm going to take what I got left and I'm going to march over to some big, old, dull, boring company that makes stuff that I buy every day, like Procter & Gamble or McDonald's or Coke or whatever. Big, boring, safe companies. So more people put money there. And the fact that they raised the dividends, or I'm sorry, that they had dividends, helped people to feel more comfortable with that. That's one of the reasons. But here's the neat part. 2.7% for non-dividend paying stocks, 12.1% for dividend paying stocks in that 10-year period. But for stocks with companies that raise their dividends those 10 years, they averaged 13.7%. 12.1 to 13.7 over 10 years is a boatload of money. That percent a year or whatever it is a lot of money. The point is safety, comfort, kind of like a comfort food idea, kind of like eating a scone. It feels good, it tastes good, and it's pretty good for me. When we talk about all this, the last thing that we think about is, okay, we've figured out how to gather the assets or how to make that income for the future. I got this income, now what do I do with it? And forget, of course, the basics, food and shelter and clothing and all that. We've taken care of that. What do we do with the rest? We can amass it up, we can build it up in a big, huge account somewhere, and then we can die and somebody else can play with it. It's like the story of the funeral hearse and the cars going through a small town, and it was the richest man in town. He passed away. And one of the fellows standing on the street corner says, "Oh, is that so-and-so?" "Yeah, it is." "Wow. Do you have any idea how much money he left behind?" The other guy says, "Yeah, all of it." Personally, I believe that any income, any assets that I may have over time are a gift to me. God gives me all this money, all these assets, all this income, and He wants to see what I'm going to do with it. Well, I know that the first thing I need to do with it is help other people with it. Notice I said first. Have enough money to pay for food and shelter and clothing and all that, but I'm going to take out a portion, and I don't believe there's a magic number, by the way. There's one that works for me. I'm going to take that and I'm going to give, it doesn't matter where you're going to give it. I mean, if personally I give mine to my church, but you can give it to the university, to the homeless shelter. The point is you're helping other people with a very a small, maybe, or appropriate percentage of this income that you've got. And you know, it's the old story, better to give than receive kind of an idea. And wow, did I find that out. Many years ago, I was in a different business, and I was quite young, and I was, well, I say that. I'll be 43 Saturday, so is that, I'm going to call it old. Is that okay? I was significantly younger then. And had a brand new wife and a baby on the way, and my company merged with another company, and my job was gone. My income was gone. I had a company car, it was gone. I had insurance that was going to pay for the child being born. The insurance was gone. I had nothing. A little severance pay, and quite frankly, the severance pay paid for the baby being born. But anyway, what am I going to do? And I went and I started to work, and I had several jobs at one time, and anyway, we'd be at church, and I'd think, you know, I should start giving some money. So I did the old deal where, well, whatever I have in my back pocket on Sunday, I'm going to put in the plate. Well, the first week that was maybe $50. The next week it was about $35, and the next week it was $1.40. Subconsciously, I knew I didn't have the money. And one time I told my wife, I said, you know, we have to start giving money. She said, yeah, I know. I said, now understand, we don't have enough money to pay the bills. She said, yeah, I know that too. Now we're going to have even less money to pay the bills. Now, we're going to do it anyway. So I started to do it, and I'll tell you what, that first check was, I had to have somebody hold my hand, because I knew that I was spending money, and now I had even less money to pay the bills. I didn't have enough money to pay the bills in the first place. But the day that started, I never, ever since then, have I not been able to pay the bills. Quite frankly, I can pay the bills and then have money left over. Wow. And the checks keep getting bigger, by the way, because it's a percentage, right? Keeps getting bigger, and they're more fun to write when they're bigger. Because all these people and I don't know who they're helping with the money specifically, because I'm not directing it, but the point is, all right, I'm doing something I ought to be doing here. And I'm feeling good about giving those assets away, giving that money away. And I'm still able to take care of the family and all of this. One little story, though, was interesting at the very beginning when I first started this. I wrote one of those first checks that I couldn't afford to write. And it was I don't know, a couple months later or something. It was towards the end of the month. And I didn't have enough money to pay the bills. Matter of fact, I was $500 short. And it wasn't coming from anywhere. I mean, I don't borrow from the parents, so that wasn't an option. My credit line was tapped out. I didn't have $500 I needed to pay the bills. It was not there. And I sat in my office thinking, golly, what am I going to do? 3 minutes later, the phone rings. Pick it up, and it's a friend of mine. At that time, he was probably an acquaintance. Now I'd say he's a friend. And he says, Brian, oh, can you help us out? He says, we have an auction charity auction up in Washington. And by the way, that's one thing I do. I'm an auctioneer. I do that on the weekends. It's kind of fun. And he said, we had an auctioneer all lined up. At the last minute, he bailed. He's sick. Can you come up and do our auction? It's short notice. I am so sorry. It's tomorrow. We'll pay for your gas and give you $500. Yes, sir. I can be there. Yes. It's amazing how those little things over time just built up and just happen. And I know, personally, I know they're happening because I'm doing what is appropriate with whatever income I get in a given year, and I'm taking that portion and I'm giving that money away. I'm feeling good about giving it away, and I'm feeling good about what is done with that money when it's done. I'm sorry, whoever I give it to when that happens. And I give to a couple of the charitable organizations we talked about, and to my church as well. Because I figure it's not my job. It's not my job to determine how that money's spent or who it's spent on or what have you. It's my job to determine, is this an appropriate place to gift assets? Whether it's, like I said, homeless shelter, your church, your school, whatever it happens to be. If you look at that place you give the money, kind of like how you look at what your money goes for other things. Let me rephrase that. If you're going to buy a house to live in, you're going to buy a nice house that you can afford that covers all the needs. You're not going to buy a tar paper shack if you can afford something better. Same thing when you're gifting your money. You're not going to gift it to some place where it's going to be wasted and thrown away and spent on something that's not appropriate. You're going to spend the research and the time to give it to some place that you trust and you feel good about knowing that it's there. And the last thing I'll throw out on that, if you can give the money anonymously, it's even better. Now, for tax purposes, on some places you need to give your name, but that doesn't need to go any farther than that. That's, I think, what feels best for me, I know, is if you can be anonymous. It's great. What I'd like to do, before we start any questions, I'd like to start, I got my most favorite book in the world here for investing. It's called The 10 Most Common Mistakes Affluent Investors Make. Did you get that part? Affluent investors make. And how to avoid them. And it's got some really, you may want to write a lot of these down because it's so fantastic. $1,000 left to earn interest at 8% will grow to $43 quadrillion in 400 years. But the first 100 years are the hardest. A study of economics usually reveals that the best time to buy anything is last year. This one is not really as much funny as it is true. There's only two emotions on Wall Street, fear and greed. And that is true. When you're doing the trading idea, when you're investing for the long term and you've got the right thing in sight as to what I'm going to do with this income, you can get away from both of those. Here's my favorite. Henny Youngman said this years ago. He said, I have got all the income I will ever need as long as I die by 4 o'clock this afternoon. Any questions about rising income and what to do with it? It is only 7:15 in the morning, isn't it? Yes? Oh, I'm sorry. Couldn't see the light.
Is it possible for, I shouldn't say is it possible, is it a fairly straightforward matter to find out what the fees are with various mutual funds, or is it difficult to find out where all the...
It should be, unless somebody's trying to hide them from you. Yeah. Seriously. Yes, that's exactly right. Now, and it's not that I expect to get this for free, because I don't, but what does it cost? I want to know what it costs. I also want to know what it costs compared to its peers, similar type. So if this thing costs X, well, right off the bat, I don't know if that's high or low. If I compare it to similar type funds and they're half as much, okay, that's a pretty good hint. There is, with the way you buy funds, there can be an upfront charge, there can be a back-end charge, there is always an annual charge, always. Any fund you buy, there is an annual charge. They're different depending on where you get it, but there's always that. Some, and again, a little personal bias will come out here, some places talk you into investing, whether it's mutual funds, stocks, bonds, whatever, on a fee-based basis. They say, not going to charge you to get in. Instead, we're going to charge you a little teeny % forever, every year. So what they say is, what they often say to sell it is, hey, listen, this is great, because if you make money, I make money. If you make more money, I make more money. And I'm just getting a little % off of what you earn. What often is left out is, and if you lose money, well, I still make money. Most of the time, for most people, I don't believe that's appropriate. I believe it's significantly more expensive than it should be. The thing is, just ask, what is it? And if you look at prospectus, Where's the charges in there? Because they're all in there. Find out what they are. Find if you're paying a reasonable fee, great. But oftentimes people are paying too much money. I've had people come in with funds that I quite frankly did not believe anybody would have the nerve to charge that much money for them. But they do. Some people do. Yes, sir.
Is there funds that are focused on growth, dividend growth?
Absolutely, absolutely. And when it comes to rising income, I would look for funds that have buy stocks that have those rising dividends, that have that income. A lot of times you might see a fund that's called an equity income fund. Typically that means they own stocks that pay dividends. An income fund could be that. It could also be a fund that had bonds in it that paid interest. Another thing about the dividends from stocks in your taxable account, they're taxed at 15%, as opposed to a bond that's taxed at your tax rate, which in often cases is going to be higher. So they're even tax advantaged at that. I think we did go over the four things about dividends. Dividends are your friend, dividends are your friend, and rising dividends are your best friend. Again, tax favored and outside of an IRA as well. Fantastic, but again, you need to look at what's in the fund, if you're looking at a mutual fund, to determine if it has those types of companies that you want to be associated with. Yes, sir.
My question has to do, I think more with mutual funds, but a management fee of 1% to 2% a year on the fund, is that a good standard as far as not being overcharged?
I think it's higher than a kite. If you're paying 2% a year on
1%, under
1% is about the industry standard. It is. Now, I'm not saying that's not.
Throw the two out.
Yeah, the two's way high. Now, I'm not saying people don't charge 2%. I saw one from another firm that just, it's been 3 months ago now, and they were paying 2 3/4%, and there were 7 digits, and they were paying 2 3/4%. It's absolutely ridiculous. 1% is about the industry average. Usually, what happens though, as there's more dollars invested, that is a negotiable fee, and it usually goes down. Give you an instance of a trust account that I was working on with somebody. It's 8 digits, and the annual fee would be something around 0.3 to 0.4, so 1/3 of a percent. Well, for the work that goes in, that might be reasonable, yeah. But 1.5%, 2%, I think that's way, way high. In some situations, it could be appropriate, but I haven't found them yet. Yes, Deb.
I was thinking it might be helpful to, I know a lot of people's 401k plans now offer like a lifestyle fund.
Yes.
And maybe it'd be helpful to talk a little bit about what those are and help people understand that.
Yeah, absolutely. And usually, not always, but usually a lifestyle choice on your 401k plan is usually a fund of funds. They say if you buy lifestyle, whatever, 20 years to retirement, maybe, whatever they might call it, it's a mutual fund that owns mutual funds that are maybe appropriate for that mix. So let's say they have this much in income, this much in equity income, this much in growth, whatever. And they bundle it all into one. Some of them even adjust that or rebalance it as your life stage goes on. As a concept, it's a good concept because it's easier to make that decision. What should I buy? You get this whole list of funds on your 401k and, you know, yikes, which one? That is absolutely the reason they come up with these, is it's much easier. The client, you can get, the client of the 401k can get diversified even faster and maybe, I might say safer almost, maybe, because you're not buying this and this and this aggressive thing and this super aggressive, this merging of markets. You're buying what maybe the prudent investor might buy for someone in your life stage. Now, usually, these are more expensive because they have to be. It's funds of funds. They're not always, but usually they are. And oftentimes you can do a simple thing like this. I do this. I'll have people show me a lifestyle fund. I'll go in and research that, and I'll find out what they have in it. Well, let's say it's as simple as it has 1/3 in income bonds, has 1/3 in equity income, and it has 1/3 in growth. Well, I can go choose the three separate mutual funds that fill that up and save the extra fees that could be associated with a fund of funds. So maybe kind of look at it and just look at the charges. And if the lifestyle fund, if it makes sense to you and you like the way that somebody's kind of chosen it for you, you don't have to lose sleep over it, and if it's not significantly more expensive than doing the individual funds, could be a very good idea. Just find out if they're charging a lot extra for it. Sometimes that's tougher to do in a 401k. Find out exactly what the cost is, because 401k funds can be charged in several different ways. The company could pay all the fees for the 401k. They could share the fees with the employees, which means you're paying more for the individual fund because it's in an IRA, or I'm sorry, 401k. It can be a mixture of the two, but usually you will see each fund and you will see what they cost in your 401k when you research each one. And again, I don't want to get hung up on the fees, and I brought it up a lot, but there are reasonable fees and there are unreasonable fees. And if your lifestyle fund, if that is something that's comfortable and you like that idea and it's not significantly more expensive, it can be a good thing to go with. But remember, an extra 1% or 1.5% can really eat up your earnings over 10, 20, 15, 30 years. Eat up a lot of earnings. Should we take one more?
Quick one.
Quick, okay.
Yeah. And I found through experience that you really have to watch those transaction fees, because that adds.
It can, yeah, it can. Absolutely. All right, thank you.
Thank you.